SIPs are the most sought after investment route to invest in mutual funds. And in this video, I am going to tell you as a mutual fund distributor, how you need to select a mutual fund scheme so that you can give or you can help your client get the desired results from their mutual fund investment journey. Hello everyone, I'm Shobhit. I'm a Fin-based growth expert and founder of Fin-based Growth Club. We are an aspiring community of new age mutual fund distributors who are determined to change how India invests. So first, let's understand why SIPs has been so popular in India. So SIPs are the biggest beneficiary, if I may say, from the mutual fund industry. Now we have more than 12,000 crore coming through mutual funds through SIPs. So this is one of the biggest tool which most of the Indian investors are using to invest in mutual funds. So if we as a mutual fund distributor are not using this route, believe me, we are missing a big opportunity, since most of us are so familiar with SIPs that we may not be familiar with mutual funds, but our investors are familiar with SIPs. So I want you guys to use SIPs to grow your business. Another benefit with SIPs are offering is it is helping investors to start with small amounts. So the hurdle which they need to cross to get their investment journey started is very, very low, and that is also giving a push for SIPs in the mutual fund industry. Other important thing which we need to understand is, since the client is starting with a small amount or comfortable amount, their expectation from those investments are also very low. And since the outgo or the financial burden on them is very small, they are ready to start and continue in that journey for a longer period of time. So this is some of the factors which has led to a growth of SIPs in mutual fund industry manifolds. This also helps in de-risking clients' investment journey. Since they are parting small amounts over a longer period of time, the volatility in equity markets can be taken care of to a larger extent. So this all has been the reason why, because SIPs has been the biggest tool to grow mutual fund industry. And if we as a mutual fund distributor are not using this mode, then believe me, we are putting a lot of money on table and we are not able to grab that opportunity. I have done a detailed session or video on how you need to use SIP as a tool to grow your business. I'm going to leave the link here. I want you guys to watch so that you can build a foolproof strategy to start and grow your business through SIP route. Now let's understand how we need to select a mutual fund scheme for SIPs so that we can give the better outcome for our investors through their investment journey. So to understand that how an SIPs can give a better return for our clients' investments compared to a lump sum or one-time investment, we need to first understand how SIP operates. So in SIP, what happens? A client is going to invest a fixed amount over a period of time. So every month or every quarter, depending upon how our client is comfortable, they can commit a fixed amount which is going to be invested over a period of time. So idea is, if the client is going to put money over a fixed period tenure or on a fixed time period, then if those investments are going to give a better return, that can only happen if those investments have a lot of fluctuation. So if he is investing today and if the market is down, he is going to get more units because the NAV of the investment are going to come down. If tomorrow market is up, he will see the portfolio values going up. So idea should be our SIPs are going to give a better return to our investors if the economy and stock market as a whole is in volatility. If the volatility is there in the market, then SIPs are going to play a better role in giving better returns to our client. Now, if the market is in the uptrend or a downtrend, then SIPs are not going to make sense because client will not be having a volatility in the schemes to capture. So one thing is sure that if we want our client to get better returns through SIPs, either market has to support in terms of being volatile over a period of time, or the investment schemes which we are suggesting to our client, that should have enough volatility so that it can capture the upswing, downswing or roller coaster movement in the investment journey. So this we need to be very, very clear that the SIPs are going to make sense to our investors or going to generate alpha for our clients only when there is a substantial volatility either in the macro environment or in the stock market, or it should have a high volatility in the schemes which we are going to be suggesting to our client. Once we are clear on this, then let me take you how we need to select a particular sector or an industry or a theme which can offer us a higher volatility in their journey. So if you are going to look at a broader market, if you are going to select, say, a Nifty or a Sensex portfolio, it is not going to have a huge volatility. Once, because of the reason that those stocks are the biggest stocks, are having the highest market capitalization, the liquidity is very high, so volatility is minimized in those stocks. So if we really want to select a theme or a sector, I would highly recommend that we need to look into those sectors which are either cyclical in nature or news driven. So for example, if you are going to choose, say, you can choose a infrastructure sector or a real estate sector or a chemical sector or a travel and entertainment sector. So these are the cyclical sectors which over a period of time will have lots of ups and downs. So if you are able to advise those mutual fund schemes which are being targeted or have a higher proportion allocation to cyclical sectors, those funds will also have a higher volatility. So this we need to keep in mind that whenever you are suggesting any mutual fund scheme to your client from the SIP investment point of view, you need to advise those schemes which are having cyclical sector allocation more, because then that is going to give a higher volatility in those investments. Those investments which have been news driven, that is also going to play a vital role. If you are going to give a diversified portfolio to your client, if you are going to give an index portfolio to your client from a SIP investment point of view, I think that is not going to play well, because it is going to just mimic the market, because every time you are investing, depending upon the market movement, you are going to get same kind of valuations, and then your investment returns from those investments would not be creating additional returns compared to your stock market. So that you need to be keeping in mind. So once you are clear on which sector or theme you need to select when you are advising your client to invest in SIPs, then let me tell you how you need to zero down which schemes in those sectors or theme you need to select, so that you can give a scheme to your client which is going to generate additional alpha returns while they are doing their investment through SIPs. So the first number which I want you guys to look into while you are selecting any mutual fund scheme from SIP point of view is standard deviation. Standard deviations are going to play a vital role to understand how volatile that fund can be in their investment journey. Higher the standard deviation, higher in the chances that the fund valuation or the movement of NAV in that fund would be having a higher upswing or low swing. So a standard deviation per se is going to represent the risk in the fund, and risk is the volatility in that fund. So if a fund is having higher standard deviation, it means that it is going to have a higher fluctuation in their NAVs or valuation of the portfolio, and that is going to play a good, or that is going to help us in generating better return through SIP route, because since we are stacking our investments over a period of time, it is going to benefit in getting additional returns from those volatility. Other important thing you need to keep in mind is, once you keep in the factor that news also are going to play a very vital role in the volatility of the stock prices, then small cap schemes or small cap stocks are also going to play a very vital role, because any news coming from those companies are going to put a lot of up or downside pressure on the stock prices of those companies. So any fund which is having a predominantly small cap bias, those funds are good for SIP purposes. Why? Because in small cap funds, the news are going to play a very vital role. Any new acquisition, any new product, any new regulation is going to give lot of up or downside in those stock prices of those schemes. So I want you guys to understand that higher volatility or standard deviation can be expected either in sector funds or in small cap or mid cap funds, because those funds are going to be driven or have a higher volatility because of the risk involved, because of the news coming in from all those companies where the mutual fund investments are being done. So just to give you a number, I have done my own analysis, and let me share my analysis with you. So I have downloaded the report for the last 3 years from moneycontrol.com, and I just wanted to know what are the funds which has given the best return in 3 years time period. So if you look at this in the 3 years time period, if you see the top 10 funds are Quant Small Cap Fund, Quant Infra Fund, Canara Robeco Small Cap, Nippon Small Cap, Prudential Technology Fund, Kotak Small Cap Fund, Quant Mid Cap Fund, BOIXI Small Cap Fund, and PGM India Mid Cap Opportunities Fund. So these are the 10 funds which has given the best return in 3 years time period. So what I want you guys to understand, as I was telling you, if we want a good return from the SIP point of view for our client, we need to choose those portfolios, those mutual fund schemes which are either into small cap or in a thematic space. Why? Because these funds will have a higher standard deviation by default because of the news driven stocks, because of the higher risk involved in those stocks. And because of that reason, these funds are going to give us a better returns from the SIP point of view. So if you are able to get these insights right and create an SIP portfolio for your client from the point of view that these stocks or these portfolios which are having either news driven movement or having a risk involved because of the size of those companies, then you should be taking an informed call as which schemes to give for the SIP purpose. I hope I have given you some food of thought as how you need to build your SIP portfolio for your client. In case this information was useful for you, in case you think that it is going to give you good insights as how you are going to advise schemes from the SIP point of view, I would love you guys to hit that thumbs up button, subscribe to our channel so that you guys will be the first one in the future to know if we publish any. Thank you for watching. I am going to see you next time.